Okay, thank you very much. Yeah. So we discussed double taxation last week, and let me give summary of this double taxation. Double taxation applied to a situation for company. A company is he has an head office in Nigeria. He now has a branch in another country. The profit of that branch in another company, they will subject it to tax in another country. And if the profit is brought back to Nigeria too, it will be subjected to tax. So double taxation applied to Nigeria head office with foreign branch. Nigeria head office with what?
Foreign
Foreign
branch.
branch. The profit of the foreign branch of Nigeria head office, the head office is in Nigeria. Dangote, the head office is in Nigeria. They now have a branch in Canada. The profit in Canada, they will call the Canada tax authority will collect tax on it. If they bring the profit back to Nigeria too, Nigeria tax authorities too will collect tax on it. So double taxation relief apply to them. So now, my last week we look at some questions in double taxation. So let's look at this number one question in double taxation now. This number one question in double taxation. Idofin and Erigon Limited, two separate entities, are Nigeria company doing well in different sectors within the economy. The owners of the two companies decided to put the resources together and form a bigger outfit for necessary synergistic benefits. Consequently, a new company, Aralomi Limited, came into existence with dynamic management team. The new company decided to take advantage of free trade within the economic of West African states by establishing a branch of its company in Cameroon. The following were extracted from the consolidated financial statement of RRME Limited for the year ended 31st December 2019. This turnover, it comprises of Nigeria turnover and what? Cameroon turnover. Do we understand?
Yes.
This overhead is for both Nigeria and Cameroon because there's a consolidated financial statement. It means they have added Cameroon operation. When you minus overhead from turnover, what do we get? Profits. Abi?
Yes, sir.
The profit now is 1,250,000. They now said part of this overhead includes some expenses, which they now break it down. That the one of Nigeria, depreciation, the one of Cameroon, 310, the one of Nigeria, 120, sales tax, value added tax on non-current assets, value added tax on revenue expenses, provision for what? Advertisement. It includes part of the overhead. You are also informed that Aroromi Limited pay $12,500 to Cameroon Tax Authority as income tax on business transaction within the period of this statement. The net profit of Cameroon operation was what? 375,000. The agreed rate of exchange is 20 naira to $1. Capital allowance. Nigeria is 90,000. Cameroon is 45,000. Require compute the tax liability of Araromi Limited after the relief of tax suffered abroad. Now, if we want to compute it using the rule of double taxation, Nigeria operation and Cameroon operation total. Like I explained, the net profit of the combined operation, both Cameroon and Nigeria, is what? 1,250,000, Abi?
Yes.
No, I know the net profit of Cameroon. How much is the net profit of Cameroon?
375,000.
So for me to know the net profit of Nigeria operation, I will minus the net profit of Cameroon from the total. Do you get it?
Yes.
I will get 875,000. That is how I get 875,000. They did not give me the net profit of Nigeria operation. They give me the total, the combined net profit, and they now give me Cameroon net profit. For me to get Nigeria net profit, I have to minus it. Do we understand?
Yes.
Add the salariable expenses. Number one, the salariable expenses that we have is depreciation. Nigeria is 120. Cameroon is 310. Another the salariable expenses is what? Sales
Tax.
tax. How is sales tax the salariable expenses? Now, let me explain something on this sales tax. Let me explain on this sales tax. For sales tax, is talking about value-added tax. VAT is divided into two. What are the two types of VAT we have?
Input, output.
Output and input tax.
VAT.
That output tax is the sales tax they are referring to.
Yes.
VAT is not under company income tax. It's a different tax on their own. Do we understand?
Yes.
For input VAT is divided into three elements. Input VAT is divided into how many elements?
3.
3 elements. Input VAT for cost of sales. Input VAT for what?
Cost of sales.
Number one. Input VAT for fixed asset, which is non-current assets. Why? Input VAT for expenses, P&L item. Now, output VAT, when you see an output VAT as an expenses in the account, you need to disallow it. Because at the end of the day, every month we do VAT payable by saying input, by minusing input from what?
Output.
Output. And we pay the net balance, Abi?
Yes.
So sales tax is an output VAT. We don't need to add it as an expenses again. Because it's a separate VAT on its own. It's not under company income tax. Do we understand?
Yes.
Now, that input VAT, there are some input VAT that will be that can be net off from output VAT. Out of the 3 types of input VAT I mentioned, input VAT on cost of sales, input VAT on non-current assets, input VAT on P&L expenses, which one will be net off from output VAT?
Input VAT on cost of sales.
Input VAT on what?
Cost of sales.
Cost of sales. Is the only one that can be net off from output VAT. Now, when you are doing adjusted profits, if you see input VAT on cost of sales as an expenses, are you going to allow it? You are not going to allow it. You are going to disallow it because it's going to be net off from output VAT. Secondly, input VAT on non-current assets. When they paid input VAT on non-current assets, that input VAT on non-current assets cannot be used as an expenses because it's going to be capitalized as part of what? As part of the fixed assets. Do we understand?
Yes.
Input VAT on non-current assets will be capitalized, will be added to the cost of the fixed assets. So if you now see input VAT on non-current assets or fixed assets as an expense, what are you going to do? You
You
are going to do,
disregard it.
you disallow it. But input VAT on expenses, like input VAT on printing and stationery, input VAT on telephone and space, they are P&L items. That one is going to be added to the expenses. So when you see it in an expenses, you don't need to disallow it. You do what? You
Allow
allow
it.
it. So go back to our question. We are giving these following expenses. Depreciation, are we going to allow it?
No.
We disallow. Sales tax, output VAT, are we going to allow it?
No.
We disallow. VAT on non-current assets, are we going to allow it?
No. Disallow.
We disallow. Why are we disallowing non-current asset VAT?
Because it will be annexed to the purchase price of the fixed asset and capitalized in the balance
Going to
sheet.
be capitalized. Do we understand? VAT on revenue expenses, are we going to allow it?
Revenue expenses.
Revenue expenses means P&L
Yes.
Income
item.
statement, yes.
We are going to allow it.
Allow, yeah.
We are going to allow it. Example of that, printing and stationery, telephone and postage, repair and maintenance. We are going to allow this. Do we understand?
Yes.
So now, for advanced staff, most of the area that I can test disallowable expenses now is on the area of VAT. It's on the area of what? VAT. They will set question on VAT. Like I said, VAT is stratified into 4 categories. Output VAT, input VAT, we divide it into 3 categories. Input VAT on cost of sales, input VAT on non-current assets, input VAT on P&L item. Out of those 3 input VAT, which one are we going to allow?
We will allow input VAT on
P&L
P&L. Yeah.
item.
Yes.
Input VAT on cost of sales, what are we going to do with it?
It will be used to, it will be netted off from the output VAT.
Output VAT. Thank you very much. So we are not going to allow them. So that is the reason why we disallow VAT on non-current assets. We also disallow sales tax. Do we understand?
Yes.
Provision for advertisement. Is it going to be allowed or disallowed? Advertisement is an allowable expense. Abi?
Yes.
But they now say provision for advertisement. They have not spent advertisement costs. They just make provision for it. Are we going to allow it or disallow it?
We will allow.
We allow.
Yeah.
Ladies and gentlemen, tax is very look somehow. Do you understand? We disallow it because we have not spent the money. Have we spent advertisement costs? We just made provision for expenses. Expenses that we have not spent. Can we make provision for it? In tax, it's not allowed. We disallow it. The only provision that we can make that can be allowed in tax as an allowable expenses is provision for what? Specific provision for what? Bad debt.
Okay.
Do you understand?
Yeah.
General provision for bad debt is what? Disallowed. Specific provision for bad debt is what? Allowed. When you now see provision for printing expenses, they have not spent printing expenses. It's different from Maybe they have spent printing expenses, they are yet to pay the vendor, or they pay in advance. But this one, they just make provision for expenses they have not spent. They now use it to reduce their net profit so that their net profit will be reduced. Is it going to be allowed?
No.
It's not going to be allowed under tax. So we are going to disallow that. So go back to the solution. You can see that depreciation is disallowed. Sales tax is disallowed. Value-added tax on non-current assets is disallowed. Provision for advertisements too is disallowed. At the end of the day, you get your adjusted what? Profit. You now less your what? Capital allowance. You get your what? Taxable profit. When you get your taxable profit, you compute your tax liability. Your CIT depends on the turnover in this case, because of this year of this question, 2020 year of assessment. It depends on the turnover. So, no, we are asked to use 30%. Sorry. We are asked to use 30% in this question. Abi, is it stated 30%? There is no 30% here. But as our 2020 year of assessment, the issue of turnover based on revenue, CIT based on turnover has not applied. Because 2020 year of assessment is doing an account of what? 2019, Abi?
Yes. Yes.
So, as at that time, CIT rate still apply for what? 30% flat. Do you understand what I'm talking about?
Okay.
You know, prior to year of assessment 2021, CIT rate was 30%.
Okay.
Irrespective of turnover. But as from year of assessment 2021, which is account of 2020, CIT rate now depend on what? Turnover. Abi?
Yes, sir.
So what is the range of turnover for each of the CIT rates? Who can mention that?
Turnover between 0 to 20, 0 and below 25 million is a small company, and because it's a small company, there will be no tax charge, which is 0%. Then above 25 million to below 100 million is 20%. Then
Okay.
above 100 million will be 30%.
Thank you very much. But it cannot apply for this account because this account, the account year end is what? 2019, Abi?
Yes.
2019. It cannot apply to them. This one, before that turnover for CIT, before that, we are using flat rate of how many percent for computed CIT? 30%. Abi?
30%, yes.
So we are going to use 30% here. So when you get the 30%, you now less your double taxation rate. Go to working note and go and compute what? Double taxation relief. How do we compute double taxation relief? Half of Nigeria tax, half of 30% is what? 15%. Abi?
Yes.
Commonwealth rate. Commonwealth rate means foreign tax paid all over taxable profit of foreign operation. Abi?
Uh-huh.
They paid Cameroon Tax Authority how much tax? $12,000, Abi? $12,500, Abi?
Yes.
When you convert it to Naira equivalent, you get the Naira equivalent. Abi? You now ask yourself, what is the taxable profit of foreign branch? The foreign branch. The taxable profit of Cameroon operation is what? 1,250,000, Abi? Can you see that?
Uh-huh.
So you get your Commonwealth rate. Your Commonwealth rate is what? 20%, Abi?
Yes.
So you now compare which one is lower among the two. Which one are we going to take as our double taxation relief?
Half of Nigerian tax rate is lower.
Which is 15%, Abi?
Yes.
So you now say 15% of taxable profit of, because out of this profit that we are doing, which one want to suffer double tax? Which one want to suffer double tax?
The income,
The
the taxable profit from Cameroon.
Operation, Abi? So which is 1,250,000. So 15% of 1,250,000, we get our double taxation relief amount. We now minus it from CIT. You get net CIT payable, which is 615,000. You now get your TET, education tax, as 2%. You get this. So hope this question is clear. Any
Yes.
question? Okay. So thank you very much. Now, we can move further and go to taxation of non-residents. Taxation of what?
Non-resident.
Non-resident. Double taxation and taxation of non-resident, they are twins brother. Double taxation and taxation of non-resident, they are what?
Twin brothers.
Twins brothers. It's the same father and the same mother that born them. But the question is different in an exam. The problem that we are having now is most of the students, they normally convince. Sometimes they will see a question of taxation of non-resident. They will be thinking that this question is what? Double taxation. They will not go and apply rule of double taxation. In that case, they will get 0 mark. They will not even get 1 mark. When you think that taxation of non-resident is a double taxation question, you're not going to apply double taxation rule to solve it. You are going to get 0 mark. Like I said, taxation of non-residents apply to a profit of a foreign what? Foreign what? Branch of Nigeria head office. Foreign branch of what?
Nigeria head office.
Head office. The company, they have head office in Nigeria. They now have a branch in another country. The profit of that foreign branch is going to be applied through double taxation, because the profit of the foreign branch will be subjected to tax in the foreign country. It will also be subjected to tax in where? In Nigeria. Double taxation does not apply to Nigeria parent company with foreign subsidiary. They are different. So let's look at this taxation of non-resident. Taxation of non-residents. So this is the topic, taxation of non-resident. Can we all see the material now? Can we see the material?
Yes.
So did you share to the group?
I shared it to the group this morning.
Oh.
Definitely.
The objective of this taxation of non-resident is to provide the general description of Nigeria tax law on what? Non-resident company. Ladies and gentlemen, what is a non-resident company? Like I explained last week, non-resident company. I differentiate between resident company and non-resident company last week. I said resident company is a company that is registered or incorporated in Nigeria under what? Corporate Affairs Commission. A resident company is a company that is registered or incorporated in Nigeria under Nigeria Company and Allied Matter Act, which is Corporate Affairs Commission. Abi?
Yes.
That is a resident company. Non-resident company is a company that is not incorporated in Nigeria. Do you understand? But as a fees base in Nigeria, and they derive a profit through that what? Fees base. What is meaning of fees base? Fees base simply means you have a branch. A foreign company has a branch in Nigeria, or he has a factory in Nigeria, or he has an agent office in Nigeria, or he has a warehouse in Nigeria. So now, taxation of non-resident simply means how do we tax non-resident company that does not register in Nigeria, but is coming to Nigeria to come and derive profits? That profit is derived. How do we tax it? Do we understand?
Yeah.
So let's look at residential rule. Resident rule for resident company and individual. Resident individual. We know that resident company and individual, they are assessed to tax on the profit that they derive in Nigeria. And if this resident company, Nigeria company, he has a branch in abroad, the profit of his branch in abroad, after being subjected to tax in abroad, he will also be subjected to tax in where?
Nigeria.
In Nigeria. But before being subjected to tax in Nigeria, what is he going to apply? What is he going to apply? Double taxation. Resident company, Dangote PLC, he has a branch in abroad. We said the profit in Nigeria will be subjected to tax in Nigeria. Also, the profit of his branch in abroad will also be subjected to tax in where? In Nigeria, Abi. After collecting tax in abroad, Abi.
Yes.
But before his profit will be subjected to tax in Nigeria, we are going to give him what? Double taxation what? Relief.
Relief.
Do you understand? So, resident rule for non-resident company. A company that does not reside in Nigeria, how do we tax them? A company, it does not register in Nigeria. He just come to Nigeria to come and he is now earning income in Nigeria. He's earning profit in Nigeria. He will be subjected to tax only based on only its profits he earned in Nigeria or he derived in Nigeria. The profit that will be subjected to tax will be only the profit that he earned or he derived in what? In Nigeria. Do we understand? So that is that. Let's look at concept of dual residence. a dual resident. Dual resident simply means a situation whereby individual or company has more than one place of residence. As an individual, me and you, we are individual. We are subjected to which type of tax from our salary? Which type of tax do we pay from our salary?
Personal income tax.
Personal income tax.
Personal income tax is based on what?
Residence.
Based on
Residential.
the,
Is based on what? Your place of residence. Abi?
Yes.
Yes.
Your place of residence, where you reside, is where you remit your personal income tax for. So, what does that imply is, assuming you are working in Lekki, you are now residing in the state. Where are you going to remit your personal income tax to?
your place of residence.
Ogun
Your
State.
office is in Lekki,
Mhm.
but you are residing in the state. Who is going to collect your personal income tax?
Ogun
Ogun
State.
State.
August.
Lagos State cannot collect it. Despite you are earning salary from your office in Lagos State, you are residing in Ogun State. Dual resident for an individual simply means a situation whereby an individual have more than one place of residence. An individual, somebody that is paying personal income tax, he has what? More than
Residence.
one place of residence. What does that mean? So maybe the person is an allergic. No, it's an allergy. Abi?
Yeah.
Now, you know all these allergy, some allergy now. He now marry two wives. Abi? Do you understand my point?
Yes.
One of his wife is staying in Ibadan, while the other one is staying in Ogun State. Every week, he normally rotates where he's sleeping. In that case, that allergy is a dual resident individual. He does not have one place of residence. He has more than one place of what? Residence. Do we understand?
Mm.
Dual residence too also apply to company. Dual residence too also apply to what? Company. Dual residence does not apply to a local company that does not have foreign branch. A Nigeria company that does not have foreign branch, dual resident does not apply to them. Take for instance, ABC Nigeria Limited. They just have office in Nigeria only. They will be subjected to tax only in Nigeria. They don't have any affiliation with other countries. Do you understand? But Dangote Nigeria PLC, Dangote have office in Nigeria. They now have a branch in Cameroon. In that case, Dangote company is a dual resident company. Is what? Dangote company is what? A dual resident company. Do we understand?
Yes.
Because he has his head office in Nigeria and he has a branch in where? Cameroon. It means Dangote will be paying two tax. He will be paying in Nigeria. He will also be paying in where? Cameroon. Abi?
Mm.
Dual residents. But a local company, a Nigeria company that does not have a foreign branch, dual resident does not apply to them. Now, international dual resident. International dual resident, this one is referring to a non-resident company. Company that does not reside in Nigeria, that does not resident in Nigeria, that does not register in Nigeria, or the company now come to derive profit in Nigeria. No, if you derive profit in Nigeria, Nigeria government will collect tax on it. Abi,
Yes.
if he take the profit back to his own country, to his resident country, take for instance, an American company just come to Nigeria to come and render one service. They now derive profit. Nigeria company will say, Nigeria tax authority will say, before you take this profit back, you must pay tax. Do you understand? It will pay tax to Nigeria tax authority. After taking the profit back to American, you also pay tax to United States tax authority. Do you understand?
So I have a question, please.
Okay.
So is this not the same as the non-resident companies?
It's the same.
Okay. All right.
So dual residents apply to non-resident company. In an exam, you can be asked, explain dual residents in relation to the following. Explain what? Dual resident in relation to the following. Number one, resident individual. Number two, resident company, which is Nigeria company. Number three, non-resident company. So if you want to explain dual resident in relation to resident individual, how do we do? Resident individual. You let them know that individual residing in Nigeria, an individual residing in Nigeria, they are subjected to tax in Nigeria based on what? Their place of residence. Do you understand?
Mm-hmm.
However, where an individual has more than one place of residence, in that case, that an individual has become dual resident. For us to determine where he's going to pay his tax to, out of the more than one place of residence that person is residing, we are going to determine which one is the principal place of residence. Let me give an example. That example of Alagi I'm giving. He has a house in Ibadan. He has a house in Ogun State because he married two wives. He's now going to the two wives. So they will ask if tax authority want to tax him. Is it Ibadan tax authority that will collect tax or Ogun State? The question is that out of the two states he's residing, which one is his principal place of residence? For us to determine his principal place of residence, you now ask yourself, which one is nearest to his place of work? Which one is what? Nearest to his what?
Place of work.
Place of work. He's residing in two places, Ibadan and Ogun State, but he's working in Lagos State. In that case, his principal place of residence will be what? Ogun State.
Okay. Okay.
Because Ogun State, is it not near to Lagos State? That Alagi is working in Lagos State, but he has two houses because he married two wives. He's residing in one of his first wife is in Ogun State. His second wife is in Ibadan. Every week, he normally go to the two places. Maybe 3 days here, 4 days here. In that case, that Alagi has become a dual resident. Abi, do you understand my illustration?
Mm-hmm.
Yes, sir.
So, now, when an individual have a dual resident, for us to determine where he's going to remit his tax to, we need to determine where is what? Principal what? Place
Yes,
of resident. Out of the two places he's residing, his principal place of residence means the place that is nearer to what?
His place of work.
His place of work. So that is dual resident for individual. When you now say you should explain dual resident in relation to Nigeria company or resident company, you can tell them that dual resident will only apply to a resident company. Resident company means a company that is incorporated and registered in Nigeria. Abi?
Yes, sir.
Dual resident will only apply to a resident company where the resident company has what? A foreign what? Branch. Example, Dangote PLC is a resident company. Abi? It's a Nigeria company. Dual resident will only apply to Dangote where Dangote has what? Foreign branch. He has an office in another what? Company. Do we understand?
Yes, sir.
So that is it on dual resident. The next heading that we should look at now is tax implication of relationship between interrelated company, dual resident company. Dual what? Resident company. What is the tax implication of a dual resident company? Number one, relationship between Nigeria branch and foreign parent company or foreign head office. A foreign company, they have a branch in Nigeria. They have a branch in Nigeria. An American company, they have a branch in Nigeria. What is the tax implication of that? Number one is no incorporation will be required for the branch of a foreign company. That is Nigeria branch. They don't expect them to go and register under Corporate Affairs Commission. However, a Nigeria branch of a foreign company will be treated as a corporate entity, and income or profit derived by such company in Nigeria will be taxable in Nigeria. What we are saying now is a foreign company, an American company, they have a branch in Nigeria. What is the tax implication? You need to let them know that is branch in Nigeria does not require to go and register under Corporate Affairs Commission. Second thing you need to let them know, the profit derived by his branch in Nigeria will be what? Will be taxable in what? In Nigeria. The profit derived by Nigeria branch of a foreign parent will be taxable in Nigeria. An American company, he has a branch in Nigeria. His Nigeria branch is now deriving profit in Nigeria. The profit that his Nigeria branch is deriving in Nigeria will be taxable in Nigeria. Do we understand? Do we understand?
Yes, sir.
Yes.
However, there are some conditions where the profit in Nigeria branch will not be taxable in Nigeria. What are the conditions? Number one condition is where the branch of that foreign company is solely used for storage of goods or display of goods. The branch that they have in Nigeria, they are not using it to sell goods. They just use it to display their goods or store their goods. Do you understand? Maybe Adidas, they have a branch in Nigeria. The branch they now have in Nigeria, they don't sell goods in Nigeria. They are just using it to showcase different products of Adidas. In such case, that Nigeria branch will not be subjected to tax. Secondly, if the branch is used for collection of information, they are not selling goods. They are just using it to collect information about how people use their products. If people want to buy their products, they will go and order it foreign. They will import their products. But the office that they have in Nigeria is not selling their goods. It's just using, they are just using the office to collect information on how people feel about their products. In such case, that Nigeria branch, since it's